Bring in Andrew Levin now, former special advisor to the Federal Reserve Board and economics professor at Dartmouth College. Professor, good to have you here. So the Fed made clear it intends to continue its QE program, sort of QE infinity, if you will. There's no time frame on when it's going to end. But will this be sufficient enough, do you think, to hold down longer-term Treasury yields?
Well, it's great to be with you today, Alexis. This is the last meeting of the year. I think one of your guests just before the hour was talking about how the Federal Reserve is now kind of on the sidelines. It's not a major player. And in some way, I think today's meeting may be consistent with that. They made no changes whatsoever in the first half of their statement today. No reference to this morning's retail sales report, no reference to any of the jobless claims data, no reference to the employment report that came out 10 days ago. The truth is that some of the recent data looks pretty gloomy. It looks like the waves of the pandemic are hurting retail sales, hurting service sector, probably causing more pain for small businesses and ordinary families. And it's not really clear what the Federal Reserve's able or willing to do at this point to help. The change they made in the statement was changing from overcoming months to saying until there's been substantial progress. But of course, substantial progress is in the eye of the beholder. So that could still be in coming months, or it could be longer. It could be infinity, as you say, that they could just continue for the foreseeable future purchasing bonds. My reading of the bond market is it didn't change much in response to their statement, which means really no news here, nothing new
Andrew?
That the Federal Reserve has to say.
Andrew, help us understand, those of us who are not necessarily economists, when Charles Evans, who's going to be a voting member of FOMC at the first meeting in 2021, he said at the beginning of December that essentially we expect to keep it the effective lower bound until we see the economy get closer to maximum employment, inflation up to 2%. And then he ended that by saying, I think it's likely to take us into 2023 and perhaps beyond. So then we get the statement today. The Fed is prepared to fire the gun. They've got the ammunition. He's certainly indicating they could, but nothing indicating they will.
Well, it would be ideal. That's interesting because they produce projections for GDP growth, for inflation, for unemployment, for the federal funds rate. One simple thing they could start to do is produce some projections for their balance sheet. That would help it make a lot more concrete, rather than vague language of substantial further progress, to make concrete both what the baseline is and what the range of views is. Even better would be to start talking about contingency planning. We can come back to that in a moment, but I think there's plenty of room here for the Fed to provide more clarity.
Professor, do you think that, arguably we have the most transparent Fed we've ever had, but going forward and perhaps maybe in today's press conference, does Jay Powell need to tell us what the contingency plans are if indeed the economy does falter in Q1, or maybe the vaccine rollout goes smoothly and the economic comeback is stronger than expected? What happens to the Fed strategy then? Have they done a good job of telegraphing that to us?
Well, and I think it's certainly controversial when you say the Federal Reserve is as transparent as they've ever been. The truth is that in August, they changed their policy framework in a way that makes it more vague, less concrete. And at the time, I think a lot of people were watching to see how they would clarify that in their communications, and it hasn't happened yet. So maybe with some of these new voting members starting in January, there will be more pressure from within the committee to improve the communications. By the way, Janet Yellen is going to be the new Treasury Secretary, by the end of January, hopefully. She was head of the FOMC's efforts to improve its communications 10 years ago. Maybe she can have some conversations with them about what's the best way forward here. The Fed cannot really stay on the sidelines. The Federal Reserve plays a key role in fostering maximum employment and price stability. American families and small businesses depend on the Federal Reserve playing an active role in doing that.
All right, Andrew Levin, former Federal Reserve Board special advisor and economics professor at Dartmouth. Thanks so much for being with us.